Hey everybody, Boris Lossberg. Welcome to the weekly technicals for the majors for euro dollar, dollar yen, and pound dollar for March 26th to March 30th, 2018. Trade war or theater as we enter into the Easter Passover week. It's holiday week. We only have 4 days to trade basically after a very, very tumultuous, highly economically laden week this week. We virtually have nothing on the calendar to trade. So it's all going to be driven in some ways by the rhetoric from DC, by rhetoric from Beijing, to see how far are they going to want to push the whole idea of tariff war. It seems right now much more spectacle than real, but the markets really don't like it. We've had massive risk sell-off for the last 2 days. Dow shaved close more than 1,000 points in the last 2 days off its index, and generally investors are much more skittish as we enter into the holiday week. Is there a possibility for a rebound? Of course, but none of it looks really, really strong. We so far have very little technical evidence that any kind of a bottom is forming. And the single biggest casualty of all of this has been dollar yen. So we'll get to that in just 1 second. But first, let's take a look at the levels, and then we'll take a look at the calendar. So on the level side, euro continues to be in this 22-24 zone, pretty much where it's been for the last month. It's very contained here. Still remains bid underneath the 23 level. Nothing much really is going on. There was some talk out of the ECB that they're now thinking about tightening monetary policy as they go forward. But remember, a lot of this bravado talk is all based on the idea that the global economy continues to churn away. Everybody's happy. Everybody is at record low unemployment rates. And even though there's no wage growth and inflation remains relatively tame, the general economic demand is actually quite good all across the OECD nations and the emerging markets. Poof, comes this chaos agent in the name of Donald Trump, and we suddenly have the specter of a trade war, potentially a lot more retribution on both sides of the equation. And if that gets out of hand, and that essentially has a very negative pall on investor sentiment, and more importantly on investment period, as businesses just kind of turn inward and stop spending as they get fearful, that creates a much more negative background for central banks. And there are some, it's interesting, I talked to a lot of I talked to a lot of bond traders who are actually much, much less bearish on bond yields than the average person, because they just don't see the bond yields crossing the 3% barrier. And if you don't see the bond yields crossing the 3% barrier on the US side, really makes it very difficult to have a normal monetary policy going forward. So as it stands right now, the default assumption in the world is that the Fed goes to 2 more rate hikes. Everybody else stays relatively stationary. The ECB moves off taper and begins to consider normalization of monetary policy. But that assumes essentially a happy-go-lucky world where nothing is really disturbed. We've had a lot of disturbance this week. The question is, was the disturbance really all for show, or does it have substance? If it is substantial, this could be the beginning of a much more deeper retrace across the board. Although the single biggest beneficiary here is going to be the yen, the euro, and the pound may appreciate a little bit on the anti-dollar basis, but not nearly as much. The pound, its own idiosyncratic story, trading 42.40, getting a little bit of a positive tailwind from all of this Brexit talk and a potentially solution. Still, the Ireland situation stays outstanding, but it looks like they're getting closer on negotiation. It looks like also the Europeans are kind of making peace with the idea, okay, the Brits are going to be out. The irony of the whole thing is the Europeans are making the peace with the idea the Brits are going to be out. The Brits are making peace with the idea they're going to be out, but going to be forced to abide by European laws. So they're essentially going to get Brexit without a vote in the European Union. It's kind of a weird situation, but all of that is naturally positive because it means the UK economy is still tethered to Europe in a lot of ways, and therefore the financial sector in UK is not completely annihilated. And of course, the yen has been the central story of the week, and it remains the central story of the week because now we took out the 105, which was a seminal level, and now the 104 remains the key support level. The key thing I think to watch this week, because there's nothing on the economic calendar, is rhetoric out of Japanese officials. are we going to get a lot more panicky conversation about the fact that this is not expressing economic fundamentals, which is just code talk from the BOJ and the Ministry of Finance for we cannot afford to have yen at these high rates and dollar yen at these low rates. We got to pump it up. So I don't think they're going to go into intervention, obviously. But the Japanese have been left high and dry. I mean, the Trump administration didn't even exempt them from the tariffs. If you're going to treat your friends this way, how are you going to treat your enemies? I mean, it's unbelievable. If I was a Japanese right now, I would, I'd want to stab them in the heart. Anyways, they're getting really squeezed from both ends. They certainly are going to just pump out tons more monetary policy as they can. But the yen continues to appreciate on a risk unwind basis, and that's the central story of the week. Calendar essentially empty. Nothing in what's in Europe here. Industrial production, economic confidence that's worth no points whatsoever. GDP that is revision, so it really doesn't have any serious value because it's already second revision, so nobody really cares. It would be, highly unlikely that we're going to have a big variance from what the expectation is. But if we do, and the variance is actually pushed to the downside, all that does is appreciate dollar yen even further. On the German side, we have CPI, which looks muted. We're actually bearish that. So again, not much of an inflationary pressure here for ECB to get excited about. And on the US side, the other big story here, and this is going to be an interesting story, is personal income, personal spending. We've had very, very lackluster retail spends. The question now is, does the US consumer get a chance to rebuild his savings? And that's going to be a big look because that may be the only positive factor for the dollar as we come to the end of the week, if that kind of jumps up, because it would suggest that jobs are finally translating into more income and that it will eventually translate into better fundamentals for the US economy. That's it. Then we just basically die out. There's nothing going on because Friday is Good Friday. Markets are closed. So that's where we stand. So let's take a look at the charts here. The euro, as I said, is just an absolute range-bound trade here with 22.50 as the bottom, 24.50 as the top. We're nudging above the top level here. Can we break out above 24.50? Very possible, but that would really require some pretty serious anti-dollar flows or perhaps uncharacteristically hawkish conversation out of the ECB. I don't think ECB really wants to rattle the cage here. I don't think the ECB does not want to see euro 125 or higher. So it's doubtful to me that they're going to try to trumpet the fact that they're going to be inflation fighting anytime soon. But the euro is trading really well, primarily just on anti-dollar flows. Did not take out the highs of yesterday, which was what, the 88s, right? 24s, right? Really, for a truly bullish structure to take place, we need to see 24 on the trade, which is possible. We could see at the beginning of the week. We certainly are trading better as we close out the week here. This candle over here confirms the fact that there's buyers underneath here. The fact that we had an engulfing candle is relatively bullish. Nothing on the calendar, as I said, to move this catalyst forward. It's really going to be, further dollar selling that could push us a little bit higher into those 2400, 2450 zone of the upper end of this range. Cable is a little more constructive, although cable had really got smacked down off the 42s. There's clearly a lot of offers at the 42s, perhaps even optionality. Again, this really is going to be driven by whatever Brexit news we have here. We do have, I take it back actually, we did have some cable news here. Let me go back to the calendar. We do have one central UK data set, which is the UK GDP numbers, the final GDP numbers. I'm not sure if it's a revision or not. Housing data and GDP is about the only thing that we have on the UK side. If it is not a revision, then this is a final. This is just simply a final print, so it really doesn't have much of an impact on data. Data out of UK has been mixed to positive. So the strong labor data certainly gave it a lot of boost, and the fact that BOE now is 2 forward on a rate hike really creates this impression in the marketplace that we're going to have a rate hike in May. So cable does have a little bit of a bid underneath it. If it can clear the 42s, it really opens up the run all the way out to like 44s here. What's the high over here? About 43, I believe. 43.50 is the high. So a clear 4200 really puts us to a test of the most recent swing highs at 43.50. But overall, cable looks to be pretty much a buy to dip. Certainly looks to be supported at the 140 level. And finally, the trade of the week, and continues to be the trade of the week. This is just ugly. I mean, About midday today, we had a decent little doji candle like this, which gave you hope that maybe this was a bottoming out formation. We got no evidence of bottom. And as a matter of fact, I think buying dollar yen here could be successful, but it would essentially be like buying a falling knife. You're essentially guessing that the 104.50 finds us at support, because ultimately this particular trade structure doesn't really justify a bottoming out until we have 1 or 2 days of green candles. At this point, the 104.50 is the next level to be tested, which could very well be on the open in Tokyo, because we'll have probably negative open in Tokyo. And then it's going to be a really interesting look to see at how 104 tests. And I think what's going to be fascinating next week is to watch the price levels against the commentary out of Japan and to see any kind of reaction on the marketplace. We are certainly grossly oversold. We're certainly due for a bounce. We're certainly way oversold on any kind of a interest rate differential basis, but it doesn't matter. As long as U.S. equities continue to go down, and as long as there's chaos in D.C., this is the chaos agent, and this is the single cleanest expression of that chaos that's going on. So for now, until we see 1 or 2 days of green candles, really, really hard to make an argument that there's any kind of a tradable bottom in dollar yen just yet. Be watching that very carefully, because that will be the trade of the week as we go into the holiday week. Wish you guys the best luck, the best trading. Boris, over and out.